Banks just panic bought silver at $72 an ounce. Not a typo, not a glitch. Major financial institutions that spent decades suppressing precious metals prices are now scrambling to acquire physical silver at any cost. And the reason why should terrify you. What if I told you this wasn't about investment strategy? What if this panic buying was the first public admission that the entire fractional reserve precious metal system is collapsing in real time? What if the banks that told you gold and silver were barbarous relics are now fighting each other for scraps of physical metal because they know what was coming? Look at your bank statement right now. Your savings account pays 0.5% interest, while real inflation runs at 8%. Your retirement fund is 60% bonds that lose value every time rates move. You were told this was safe. You were told the system was stable. The banks buying silver at $72 know something you don't, and they're not buying to protect you. They're buying to survive what they created. Drop a comment. Where are you watching from? Because this liquidation event connects every currency, every market, every savings account on the planet. Hit subscribe if you want the unfiltered truth about what happens when the people running the casino realize the chips are worthless. You're going to need it. Let me show you the trade that broke everything. March 2020, the world locks down, markets crater. The Federal Reserve launches unlimited quantitative easing, printing $4.5 trillion in 18 months. But here's what they don't tell you in the press releases, that money did not go to Main Street. It went to banks as emergency liquidity to cover a derivatives blow-up that would have collapsed the global financial system in 72 hours. The Bank for International Settlements reported $640 trillion in outstanding derivatives contracts in 2020. Read that number again, $640 trillion. Global GDP is $100 trillion. The derivative market is 6 times larger than the entire world economy. And it's all built on leverage, speculation, and the assumption that counterparties will always be able to pay. Sound familiar? That's the same assumption that collapsed long-term capital management in 1998, Lehman Brothers in 2008, and Archegos Capital in 2021. Every single time, central banks stepped in to prevent contagion. Every single time, they made the problem bigger by adding more leverage and more printed money. And every single time, they promised it wouldn't happen again. But here's the mechanism they never explain. Derivatives aren't just bets on asset prices. They're collateral chains. Bank A uses treasury bonds as collateral to borrow from Bank B. Bank B uses that same collateral to borrow from Bank C. The same asset gets rehypothecated up to 40 times in shadow banking. When prices fall, everyone demands their collateral back simultaneously. That's a liquidity crisis, and there's not enough collateral to cover even 10% of the claims. Gold and silver were supposed to be the escape hatch, the assets outside the system, except Western banks turned them into derivatives too. Paper gold, paper silver, ETFs backed by unallocated metal that doesn't exist in proportion to claims, COMEX futures, where 400 paper ounces trade for every physical ounce in the warehouse. The same fractional reserve scam they run with currency, applied to the only assets that could expose the scam. It worked for 50 years. But in 2025, something broke. China, Russia, India, central banks that hold $3.2 trillion in U.S. treasuries started demanding physical delivery of gold and silver instead of accepting paper claims. They stopped playing the game. And when you drain physical metal from a fractional reserve system, the leverage collapses. Sound familiar? That's a bank run. The same dynamic that collapsed Silicon Valley Bank when depositors asked for their money back and the bank didn't have it. Except this is happening in precious metals markets worth hundreds of billions, with derivative exposure in the trillions. And banks can't print gold. They can't print silver. They either have it or they don't. They don't. So they're panic buying. At $72, at prices they spent decades telling you were irrational. And if you think that's the shocking part, wait until you see who's selling to them. Here's where it gets wild. The paper-silver market operates through 3 interconnected systems: COMEX futures in New York, London bullion market, unallocated accounts, and silver ETFs. Each layer adds leverage. Each layer assumes the other layers are solvent, and each layer just discovered the other layers are lying. COMEX silver futures trade 290 million ounces daily in contract volume. Physical silver? In COMEX warehouses, 285 million ounces total. Think about that. The entire global warehouse inventory trades in paper form every 24 hours. The velocity is insane. The leverage is catastrophic. And in February 2025, something unprecedented happened. Delivery requests exceeded available inventory for 3 consecutive months. COMEX responded by changing the rules. They increased margin requirements by 40%. They modified contract specifications to allow cash settlement instead of physical delivery. They even suspended some delivery months entirely, claiming operational challenges. That's exchange speak for, we don't have the metal and we're buying time. But time ran out on March 15, 2025. Silver hit $72 in overnight Asian trading, not because of industrial demand, not because of investment flows, because JPMorgan Chase paid 72 per ounce for 8 million ounces of physical silver from a private dealer in Switzerland to cover delivery obligations they couldn't fulfill from COMEX warehouses. You won't believe the receipt is wilder than you think. Let's break down the exact mechanism and why this liquidation event is accelerating. 8 million ounces at $72. That's $576 million for metal that was officially priced at 28 3 months earlier. JPMorgan didn't pay a 157% premium because they're bullish on silver. They paid it because they were short 15 million ounces in paper contracts and facing regulatory action if they defaulted. This was an investment. This was survival. And JPMorgan isn't alone. The latest Commitment of Traders report shows 8 commercial banks hold net short positions totaling 310 million ounces of silver futures. At $28, that's manageable. At $72, that's $13.6 billion in mark-to-market losses. Banks don't absorb $13 billion losses quietly. They liquidate other positions. They call in loans. They trigger margin calls across the system. This is how contagion spreads. Silver derivatives blow up. Banks sell treasury bonds to raise cash. Treasury prices fall. Interest rates spike. Mortgage rates jump. Housing prices collapse. Stock portfolios crater because everyone's leveraged to everything else. One derivative failure cascades through the entire financial system because it's all connected through collateral rehypothecation. The Bank for International Settlements admitted in their 2024 annual report that cross-border collateral flows reached 18 trillion daily. That's collateral moving between banks, brokers, and central banks to support derivative positions. When collateral gets repriced, like silver jumping from 28 to 72, every institution in the chain faces margin calls simultaneously. There's not enough liquid capital in the world to meet those calls, so positions get force liquidated, markets gap, systems break. Now let's talk about who's on the other side of these trades, because while Western banks panic, buy at $72, someone's selling at $72, and it's not retail investors or mining companies. It's sovereign wealth funds and central banks that accumulated physical silver between 2015 and 2023 when prices were suppressed below production costs. China's State Administration of Foreign Exchange holds an estimated 230 million ounces of silver through proxies and shell companies. Russia's central bank accumulated 78 million ounces between 2014 and 2022. Saudi Arabia's public investment fund bought 42 million ounces in 2021 alone. These aren't speculation plays. These are strategic reserve positions acquired specifically to exploit the Western paper market when it broke, and they're selling now. Not all of it, just enough to force Western banks into liquidation. They're feeding physical metal into the market at $72 to create the illusion of supply, while simultaneously buying more at suppressed paper prices on COMEX. It's the greatest financial arbitrage in history. They're draining Western bank vaults, accumulating metal at a discount, and forcing banks to buy back their own short positions at massive losses. Here's the greedy part. Western banks knew this could happen. Internal risk models at every major institution flagged precious metals exposure as systemically dangerous in stress tests going back to 2018. But the carry trade was too profitable to stop. You borrow silver at 1% through leasing agreements, sell it immediately at spot price, invest the cash in higher yielding assets earning 5%, then buy back the silver later to return it. Free money. Except you re-naked short physical metal in a market where supply is finite and demand is growing. Industrial demand for silver grew from 487 million ounces in 2010 to 678 million ounces in 2024. That then is a 39% increase driven by solar panels, electric vehicles, and electronics. Supply growth? Well, only 18% over the same period. The deficit accumulates every year. Above-ground stockpiles shrink. And banks kept shorting because they believed they could always suppress prices through paper market manipulation. They were wrong. And now comes the moral hazard. Central banks will bail out the commercial banks. They always do. The Federal Reserve, European Central Bank, and Bank of England will provide emergency liquidity through repo facilities and currency swaps. They'll create special purpose vehicles to absorb the derivative losses. They'll label it systemic stability operations and sell it as protecting depositors. But here is what really happens. Your currency gets debased to save banks that gambled with leverage. Your purchasing power declines to backstop derivative positions. Your savings evaporate, so institutions that created the crisis don't face consequences. That's parasitic finance. The system extracts wealth from productive labor to cover speculative losses through financial engineering. Sound familiar? In 2008, taxpayers bailed out banks to the tune of $700 billion through TARP. But the real bailout was $16 trillion in emergency lending facilities that the Federal Reserve didn't disclose until a congressional audit forced transparency in 2011. Banks that should have failed got rescued, executives kept their bonuses, and homeowners lost everything. And it's accelerating. In the 2 weeks since silver hit $72, we've seen emergency meetings at the bank for international settlements, coordinated interventions in precious metals markets, statements from central bankers about orderly market function. All the same language they used in 2008 before Lehman collapsed, and in 2020 before the COVID derivative crisis. The pattern is clear. Crisis, bailout, bigger crisis, bigger bailout. Each cycle increases systemic leverage. Each cycle makes the next collapse worse, and precious metals are the canary in the coal mine because they rue the only assets that can be printed, bailed out, or rehypothecated into infinity. When paper silver diverges from physical silver by 157%, it's telling you the paper system is dying. Let's quantify what dying means. Silver mining companies produce 830 million ounces annually at an all-in sustaining cost of $22 per ounce. At $72, that's 227% profit margins. Miners will ramp production, right? Wrong. New mine development takes 7 to 10 years. Existing mines are already running at capacity. There's no supply surge coming. The only sources of new supply are recycling and above-ground inventory drawdowns. Above-ground inventory in COMEX, London, and Shanghai warehouses totals 1.1 billion ounces. Sounds like a lot, until you realize industrial demand alone consumes 678 million ounces annually. Add investment demand of 241 million ounces. That's 919 million ounces of annual demand against 830 million ounces of supply. The deficit is 89 million ounces per year. At that rate, warehouses empty in 12 years. But demand is accelerating, not stabilizing. Electric vehicle production is projected to grow 340% by 2030. Each EV contains 25-50 grams of silver in its electrical systems. Solar panel installations are growing 18% annually. Each panel uses 20 grams of silver. 5G infrastructure, medical devices, water purification, every technological advancement increases silver consumption. The deficit isn't shrinking, it's compounding. And here's where the engineered collapse becomes obvious. Banks have known about peak silver for 15 years. Geological surveys published by the USGS show declining ore grades and depleting reserves. Yet derivative exposure kept growing. Paper silver trading volume increased 420% between 2010 and 2024, while physical supply increased only 18%. That's not market making. That's deliberately creating a time bomb. Why? Because the derivative market generates fees, spreads, and carry trade profits measured in billions annually. Physical silver just sits in vaults generating nothing. So banks maximized derivative leverage to extract maximum profit before the system collapsed. They knew it would collapse. They just planned to be bailed out when it did. And they were right. The Federal Reserve's balance sheet expanded by $4.7 trillion during COVID. Where did that money go? Emergency repo facilities that kept derivative markets functioning. When you hear liquidity crisis, that's code for banks can't meet derivative margin calls and need printed money to avoid defaulting. The bailout is built into the system. The moral hazard is permanent. And your currency is the collateral damage. Here's the illusion. You think your money is money. It's not. It's a claim on future productivity. When central banks print trillions to bail out banks, they're stealing your future productivity to cover past gambling losses. Inflation isn't a bug, it's the feature. It's how they transfer wealth from savers to debtors, from workers to financial institutions, from the productive economy to the parasitic derivative casino. And silver at $72 is the proof. Banks that spent decades telling you precious metals were irrelevant are now paying premiums of 157% for physical metal. That's desperation. That's acknowledgement that paper claims are worthless and only hard assets matter. They're not buying silver to fight inflation. They're buying silver because the derivative chains that connect every financial institution on the planet are snapping one link at a time. The liquidation isn't just silver, it's everything. Bond markets, real estate, equities, every asset class is interconnected through collateral rehypothecation. When one market reprices violently, the shockwave propagates through the entire system, and the speed is terrifying. In 2008, Lehman's collapse took weeks to spread. In 2025, with algorithmic trading and digital markets, Contagion spreads in hours. One failed derivative triggers a cascade of liquidations that no central bank can contain fast enough. Here's the dark truth. The 2008 financial crisis wasn't resolved. It was postponed through printed money and zero interest rates. The COVID crisis wasn't resolved. It was postponed through $16 trillion in global central bank intervention. The silver crisis won't be resolved. It will be postponed through even more printed money. But each postponement makes the eventual reckoning exponentially worse. The Western financial system is built on borrowed time, not years, months. The derivative leverage is unsustainable. The collateral chains are breaking. The sovereign wealth funds understand this. That's why they're selling physical silver to Western banks at $72 while simultaneously reducing exposure to dollar-denominated assets. They're front-running the collapse. They're positioning for the revaluation of hard assets against fiat currency. And they're doing it with your pension funds, your bond holdings, and your bank deposits as collateral. Denial is not a strategy. Hoping the system self-corrects is not a plan. Every institution you were taught to trust, central banks, commercial banks, rating agencies, regulators, is complicit in creating this derivative monster. They benefited from the fees, the bonuses, and the political power that came from controlling trillions in leverage. They're not going to fix it. They're going to extract maximum wealth before it implodes, and then blame external shocks, geopolitical events, or unprecedented market conditions. But you know better now. You've seen banks panic, buy silver at $72. You understand the fractional reserve scam. You recognize the derivative time bomb. The question is what you do with that knowledge. So here's the final question. Are we wiser now, or are we walking the same path in better suits? Drop your thoughts below. Share this with someone who still trusts the system. And subscribe, because when the liquidation event goes full scale, you'll want to know which assets survive and which vanish into accounting fraud. The banks buying silver at $72 already made their choice. Make yours.